Aloha.
Aloha.
As you can see, the debt clock is ticking. Some of you think it's 14 trillion that we're in debt. We're going to hear from the expert, Sheila, who's come all the way from Chicago, the Chicago area. What we've got is a state of the nation where 40 cents on every dollar of every expenditure in Washington, D.C. is borrowed money. I, as a legislator, am ashamed to admit that I had not realized that the cost of government had raised such a need for borrowing so much money. How do we stop this? How do we get out of it? How do we keep the American dream still available to the Americans that we represent?
Pleased to take part in this important informational briefing. It's time for government officials at all levels, national, state, and local, to have a real conversation with the American people about the amount of debt that we are carrying and how we are going to get ourselves out of the fiscal hole that we have dug. This informational briefing is a start to that conversation. I'm particularly concerned about meeting the promises we have made to our senior citizens while not crippling the economic future of our children. Governor Abercrombie has warned that Hawaii is facing an economic storm with unfunded pension and health care costs approaching a staggering $22 billion. Unless we start to pay off these debts, we will not be able to fulfill our commitments to retirees in our state. I'm impressed with the caliber of speakers we have here today, and I look forward to listening to their analyses, and hope together we can begin to develop a path to address our government's fiscal problems. Thank you very much.
Thank you, Barbara. On the Senate side, we have an economist and former banker, Sam Slom. Sam, would you like to say a couple words?
Thank you, Gene. Good morning, everyone. I can't stress the importance of the issue. The problem is that the public can't get their hands and brains around the issue. It's just not something that is common. Again, I think it might be partially an indictment of our educational system because we don't talk about economics, we don't talk about fiscal matters, we don't ask how much something costs and where it comes from. The good news is that all of our problems have been man-made. The good news is that we can solve these problems, but we've got to have the political backbone and the will to do it. And I think right now we are in a struggle. We are at a tipping point as to whether or not we are going to reform these practices that have led us here, or whether or not we're going to continue down the same road, continue to kick the can. I view the problems with debt and the overspending and overtaxation of our government as a form of economic terrorism, and it's got to end.
Representative Cynthia Thielen, and I represent the Windward side of the law. My focus has been on the green economy, that if we go forward with renewable energy, we're creating good-paying jobs. And I've seen really a dearth of that kind of activity with the present administration, both in the state and national.
Aloha, my name is Sheila Weinberg. I'm a representative for the North Shore of this island. And there's going to be a lot to learn today, so I'll leave it real brief. Thank you all for being here.
Good morning, everyone. My name is Representative George Fontaine. I represent South Maui, which is Kihei, Wailea, and McKenna. And again, I'm here to learn and participate and hopefully hear some new ideas on how we can turn things around. Thank you.
Thank you so much for inviting me. I'm honored and thrilled to be here. And enjoyed my time over in Kona yesterday. I think part of the problem is that the public has been told for decades that the state's budgets have been balanced. And so therefore the public has been thinking everything is fine. If you balance your budget, then your revenues equal your expenses, and you're not running deficits, and you're not increasing your debt. But that has been contrary to what has actually been going on. And we believe it's because the states do not use truth and accounting when they calculate their budgets. Today I'm going to talk about three things. One is just the transparency of the reporting of a state's financial condition. Two, the important necessity to provide citizens with the knowledge they need to make informed decisions about their governments. And three, to talk about the need for what we call fact-based budgeting, which I will get to later. For the last year, we have been calculating the financial condition of every single state. Because of poor accounting standards, states' financial conditions have been very opaque, and their financial statements do not show the real picture. So we just finished the financial state of the states, and we have a financial state of the state for every single state. And you'll notice that Hawaii is in the, quote, top sinkhole states. I don't know if that's a top or a bottom thing. And we calculate that each taxpayer, what we call taxpayer burden, is $25,000. We calculated this, it's the first time that an overall approach has been done. A lot of studies have calculated just the pension plan numbers, but what if a state, in order to fund their pension plan, borrows? So Washington State, actually, in their pension plans look pretty good, but that's because they borrowed their money. And also, we took into consideration if states had assets to pay the liabilities, then those should also be considered. And then the big thing we did was we added the retirement system's unfunded liabilities. Keep in mind, we did not do calculations of those ourselves. We used state actuaries' numbers. This is what we came up with for Hawaii, is that the state, including, this is for their primary government and for their component units, has, in 2009, we used 2009 financial statements because Hawaii is the last state to have their 2010 financial statements out, June 30, and those are still not out today. The 2009 were issued 477 days after the fiscal year end. But what we found in 2009 was the state had $19.5 billion of assets. But in our calculations, we said, well, the state realistically should not be, and it's hard to sell capital assets to fund bills. And then you also have 2.3, almost $4 billion of restricted assets that you've restricted by law or by contract or by the federal government has restricted. So you have $3.9 billion to pay your bills, but our calculations show that you have $15.4 billion, so it leaves you with almost $11.5 billion that you need to pay your bills. The burden represents the amount of bills that previous elected officials have incurred. The state has incurred these bills already, and they did not pay for them. Next slide for it, please. We calculated the per taxpayer share based on the number, we could not find the taxpayers in every state, so we did it based on the number of federal taxpayers who actually paid tax on their federal return. In a lot of states, this approximates your number of households. Here in Hawaii, the households is less. So our numbers, if you did it by households, our $25,000 would actually be higher. And a per capita tax number is $8,872. The transparency of the state's financial statements honestly is not in your control. The legislature and governor and the comptroller do not decide what's reported on your financial statements. It's the Governmental Accounting Standards Board. And honestly, if you want a clean opinion on your financial statements, you cannot report your pension liability at this time. You could decide to disclose your report on your balance sheet, your retiree health care benefits, but you can't. So the question is, what is reported? For your retiree health care benefits, on the financial statements, on your balance sheet, $925 million is reported. Again, these liabilities are what your state actuaries determine. And we have problems with transparency because it isn't until page 125 of your financial statement that you see the real numbers for your retiree health care liability. And they show that for your employer union health benefit trust fund, that fund has no assets set aside to pay $7.3 billion of liability. And to give you a comparison, this is 4 times the amount of payroll. You would have to stop paying your employees for 4 years and just put it into the pension plan, the retiree health care plan, to catch up. And then you have the other plan, which is about $1.6 billion underfunded. Again, you have no assets set aside, for a total of 8.9 of those. The pension, one of the reasons that this number, I believe, is so high is because the accounting standards didn't even make you calculate that number until 2008. And it goes back to the old adage that if you don't measure it, it's very difficult to manage. And so states are just starting to manage this liability because they're starting to measure it. And some states are actually setting assets aside. So let's go to the pension liability. How much of that is reported on your balance sheet? And none of your pension liability for retirees, employees' retirement system is reported on your balance sheet. Your employee retirement system is what they call a cost-sharing multi-employer plan. The state and the counties involved. And the accounting rules have that no liability is reported on the balance sheet for those type of plans. And there's no footnote disclosure of those liabilities. And they don't keep track of how much is the state share and how much is the county share. The plans are not required. It's kind of like if you were in a mutual fund and you gave them money, they don't keep track that, the senator gave them money and for how much. They don't keep track of that. And then they don't know how much you owe back. We found in your system's financial statement is that the liability is actually $5.1 billion. But again, that's for the state and the county, so we did not include the county's portion. But again, your state's actuaries do not calculate how much your state share is. So we did it based on your contributions that you've historically made into the plan, which were about 76%. So your liability that we included on your financial, is actually $3.9 billion. Okay. Yeah, you can show. Yeah, this slide. So it's $3.9 billion. So in total, you have retirement liabilities of $12.8 billion. And only $8.6 billion of those have ever hit your financial statement, your budget. We are very fortunate. We're at a very critical time right now that the Governmental Accounting Standards Board has issued an exposure draft that would amend these pension reporting standards and require state and local governments to start to report these liabilities on their balance sheets. And my understanding is that the states would have to start doing that with their 2014 comprehensive annual financial report. And honestly, the way, again, we calculate the numbers using your state actuaries and how they currently do their benefit calculations, which includes things like an 8% assumed rate of return on their investments. It also includes that the amortization of old unpaid benefits is over a 22-year period. This standard will require those to be only amortized over the remaining employees' working period. So it will shorten that down. So your liabilities are going to be higher once they make them. So under these standards, we believe that the citizens are not being informed about these liabilities and that these are very real liabilities. And just because they're not reported on the balance sheet doesn't mean that they don't exist. And we believe that they should be included in the budget process. The governors and comptroller and you guys need to let, and other government officials, even though they're not on the balance sheet, really need to let the public know that these are going to be, these liabilities exist. We do applaud the governor and legislatures for diligently paying what they call the annual required contribution. This is kind of like paying your minimum contribution on your credit card. They have been paying that. Theoretically, if they paid this balance for the next these contributions for the next 22.5 years, that the balance would be paid. But this plan started in the late 1990s, and it's a 40-year plan. And so theoretically, you would think that the balance is going down, but your balance is actually significantly going up, even though you're theoretically paying it down. I would also strongly recommend, right now you are not paying the annual required contribution into your retiree health care plan. And this again is what the actuaries calculate would, I'm not sure what year you're using, it would be a 10 to 30 year period that you're amortizing these benefits. And again, these are not benefits that are incurring in the past, these are benefits that incurred in the future, they're benefits that have incurred in the past. Some are arguing, well, this is a pay-as-you-go system, so why should we not just continue that? These retirement benefits are part of your employee's compensation package. There's salaries that they earn every year, and then they earn the right to receive these retirement pension and retiree health care benefits. And just like the salaries, You include those into your budget, so you should also include these pension and retiree health, even though you're going to not write the check for years, they're a current cost of this year. Hawaii is Hawaii, like 48 other states, have a balanced budget requirement, and you have it for a good reason. And the major reason is so that your public can be held accountable. The balanced budget amendments are there to make sure that you have sufficient current revenues to cover your current benefits and services. And all of these costs need to be included, including the the compensation cost in relation to your pensions. Another way to think about this and this employee compensation is, what if you didn't offer your employees these benefits? Would their paychecks not have to be higher? And so therefore that, and another way to think about it is like a credit card. Let's pretend that you're an individual. You buy something or you consume something in a current year, you put it on your credit card. And then the bill comes, and then you have the choice of either paying that balance off right now or paying some of it off right now. If the cardholder, if you decide not to pay only a portion of it, then instead of the entire balance, what you're doing is you might spend that, and a lot of citizens have, spent that on something else more gratifying than paying off their credit card balance, and a lot of people have gotten in trouble about that. But just because you don't decide to pay the balance doesn't negate the fact that you consumed those goods or services in that period. And if the card holder, and when you leave it on your card, what you're doing is you're deciding to, in the future, dedicate some of your future earnings to pay this balance instead of plus interest. And imagine if you just didn't even pay the minimum balance, how high this balance would get. And then you would have to pay penalties and interest. And this is in what the states are doing in a similar way in charging their compensation costs to the retirement plan's credit card. And when employees work every year, they provide current goods and services to the state, and the state, the salary portion is being included in their paycheck, so that is being included in your balanced budget, but the retirement part is being charged to your credit card. And the actuaries send you a credit card statement periodically that has your credit card balance, which is called your unfunded actuarial accrued liability. And they also calculate what your contributions are, kind of like your minimum payments. Again, the state has a choice once they get that credit card balance to pay off the balance or to only pay off a portion of it. And if you don't pay off the balance, then you get the benefit of, well, if you did pay it off, citizens would be like, well, you're just paying into the pension plan. You can probably spend it on something more sexy that your constituents would probably like better than just paying into the retirement plans. But because the state has made the decision not to pay these balances off, does not negate the fact that these compensation costs did occur in the current period and were earned by the employees in that current period. And then the other thing you're doing is, to the extent that you haven't paid them off, is the state is making an implicit decision to devote future taxes of future taxpayers to pay the balance plus interest. But the state doesn't even pay the minimum balance. With the retiree health care benefits, you're not paying any of the minimum balance at all. And future taxpayers will be burdened with these balances plus interest. So they're going to, in 20, 30 years, they're going to be paying for these benefits, but they're not going to receive any goods or services for those benefits. And they're just going to be burdened with those. And that's why we calculate each taxpayer's burden. And this, pushing these costs off into the future is in direct confrontation with the reason that you have your balanced budget requirement, which is intergenerational equity. And that is one set of taxpayers. You shouldn't be able to burden future generations with the cost of a prior generation's bills. As mentioned, to truly balance your budget, all these costs must be included. And in addition to your compensation costs, we found that not all of your prior balanced budget calculations included other bills. You'll see the 2008 balance, and let's focus on your, what they call other accrued liabilities. And that balance was $357 million as of June 30, 2008. In the fiscal year 2009, that increased by $227 million to have a balance now of 585. So by this increase represents the amount of expenses that have been pushed into future years. This is an increase in debt that future year taxpayers are going to have to pay. I could not, and the financial statements did not identify what this accrued liability amount, I could not find in the financial statement what this accrued liability amount is. So we believe that we've developed a system to make it so that the state includes all the costs and related revenues in their balanced budget calculations. And we've developed something that we call fact-based budgeting, which is full accrual calculations and techniques. With this system, the citizens would have the information that they need to know whether their politicians are living within this balanced budget requirement. It would require the disclosure of the true cost of government, and only revenues that were earned in that period would be included, and all of the costs would be included in the budget, regardless of when it changed hands. Obviously, the retirement benefits that were earned in the current period would be included, and you would not be able to incur any future debt. Citizens would have the information then that they could hold their legislators accountable. Again, you have the balanced budget requirement so that you'll have to think about, the taxpayers are not going to pay for more government than they're getting. But if they're getting government that costs this much because all the costs are not being included, and they're only paying this much, then hey, they're thinking they're getting a good deal. People are going to get reelected. But if the taxes were at the same level or the benefits were reduced to be at the tax level, then they could hold their elected officials accountable. With facts-based budgeting, citizens, more importantly, would have the information that they need to be informed participants in their government. And we urge that this is not just an accounting issue. I know it sounds like a numbers game, but governments have a special responsibility to report on their decisions and the financial consequences of those decisions. And we believe that our democracies are at risk. Thomas Jefferson said that an informed electorate is the basis of a sound democracy. So I ask you, what type of democracies do you get if the government is misinforming their public? And I will leave you with that question.